All right. There we go. We should be, we'll get started here in 1 second. Team, good morning. I threw a surprise at you, Alex and Terry. We might be setting history here at Trading Analysis that we are streaming on both YouTube channels and Twitter.
Whoa,
cool.
What? Huh?
Whoa.
That started at 5 a.m. this morning. I tested it twice, and it works.
Whoa. So where we are on Twitter?
Yeah, it's on. Oh, look at that. It's working. Oh, yeah. It's going to be a good show. Good morning. Look at
Good morning,
that.
everybody.
Yeah, all right. Hey, good morning, Alex, Terry. What's up? How you guys doing? Terry, you're surprised, aren't you? You didn't think I'd pull this off.
Yeah, it was a struggle to try to get even just get one YouTube or one live stream running, and so now you got it on 3. So congratulations.
Thank you very much. I see Facebook. Cool. I see Twitch. I think we're all too old for Twitch. Does it? I don't know. I don't know.
I'll be playing video games for Twitch.
Well, Terry, not to put you on the spot, but you're a gamer, so I mean, you might even Twitch. I don't know. You can answer that as you see fit.
Oh my God.
All right. So, and you know what?
Grand Theft Auto.
Oh, I miss Grand Theft Auto and Call of Duty. Someday
I didn't play any of that. My God.
Someday I'm going to have time to play video games. Guys, we're going to get started here in 1 sec. We got a good show for you. And in theory, these nice people say I can respond to all chat messages at once. So we'll see if that is going to work, but I'm not going to press my luck. Alan says, in my new thing, new Twitter CEO, Todd Gordon. Yeah, right. Yeah, right. Pretty interesting news. I guess I'm not all that surprised out of Elon. He says, I want to find a replacement if anybody actually wants the job. All right. So we are good. We're going to get rolling here. Good show for you. Coming into the end of the year. Futures up here pretty good. All right. Let's just make sure we got questions up. And we're going to take it away. All right, guys. Opening comments. Good morning. Welcome to the TA live stream on 3 channels. Crazy kind of end of the year here. Highly oversold. We'll look at where we are in the indexes. A lot of rotation. Terry, Alex, and I have been working real hard behind the scenes as to sort of looking at coming plays into the new year. Where capital flows might be. Big move out of Bank of Japan. We'll get to that with Alex to figure out on the macro flow, which has been a key driver of equity markets in here. You got to know where the other 3 major asset classes are going: commodities, fixed income, and currencies, as it's having a big impact on the equity markets. So let's dive in here a little bit, guys. Opening comments or just hit it.
Yeah, just get into it. I mean, we're coming into the end of the year here. Last week, it's really going to be light volume trading in my mind, but don't really expect anything dramatic. But I think once we get this year behind us, exactly, Todd, we've got a lot of good things coming up for you guys in the next year.
Yeah, that's for sure. We're working hard behind the scenes. This was a I don't know, 11 p.m. to last night, 4 a.m. up this morning. Finish hard at the end of the year. This is a good time of year to step back, either work on your business, work on your trading, work on your family life, work on your personal life. Markets have made a good move down. They're kind of stabilizing. I'll show you where we think we are in the indexes, but end of year, always a good time to sit back and reflect and look at what you've done in the past year, what you did right, what you did wrong, what you're going to do better next year. You taking care of yourself, with so much stress, talking to people on the wealth management side, everyone has some story of things that just were less than ideal in their lives this year. I think most of us, myself included, have that. So we've just got to kind of rest up, prepare, get ready for 23. Will be more of it. This will be more of the same. Who knows? We got to be equipped to do it. But just a good time to sit back, relax, and get your mind right. Get the business right, the finances right, your trading plan. Let's work on that. So we'll be working on that with trade analysis clients, and let's dive in here. So yeah, okay, Scott, good opening. And you know what? We're gonna hit that. That's a good opening there. Equal weight. Yeah, there's a lot of movement below the surface in mid and smaller cap. We're doing a lot of sector work, looking at the cap weighted sectors versus equal weighted. There's a lot of stuff going on below the surface, which is interesting. So, all right, let's go. First of all, the stock market could go higher or lower from here. That's my big announcement. That's the big takeaway for the year. So, this is the same exact count that we looked at last Wednesday. It's still very conceivable that we're 5 off the lows here after a pretty significant ABC down. October 13th is a significant move. We have two sort of zones here in the SPX carved out as should holds and must holds. Now these are typical fib retracements of a 5-wave move. This is again proposed that the wave 5 completed here. This was a monster zone. We basically said this would be a battlefield littered with traders and investors' bodies. Because there's every conceivable technical level here. You have the 200-day moving average, you had downtrend resistance from the 2022 high, you had a 50% retracement from the 2022 high, you have the 786 retracement from the August high, you had internal fib projections here, you had the old September 12th high here. This was a pretty big zone, and I did say to everyone, I don't think many people are going to get out of here unscathed. If you had the shorts on, you wanted to sell the double top, yeah, good for you. You're probably doing okay. So what is the likely path from here? As we get off the daily down into the half-day chart, sub-daily, let's get down to 195. Let's even go smaller. Let's go 60-minute. The big question on the table, and this is a core takeaway that I think you'll have from your short time here with us, is the move down. It is certainly 5 waves. Where this wave 4 goes is still TBD, to be determined. We have futures up here pretty good. I saw 7/8 here last. I'll check it. Is wave 4 going to go up here, fail around 38.60, come down and test this big support zone here? Or was that all of wave 4? This is dinky little wave 5, and we're headed higher. And we're going to make a pretty good B-wave move up. Question on the table is this 5? And if it's 5, is it A? Is a 5-wave A, which means we need 3-wave B, and then another 5-wave C for the completed zigzag. The question on the table is, do we have enough room? And I know Alex has a strong feeling on this. Do we have enough room to have a 5-wave move down to give us the classic 5-3-5 zigzag above what I have labeled as the must-hold zone? For me, the 786 retracement off of any 5-wave move is the must-hold zone. So do we have, and will the market obey and carve out that 5-wave move somewhere between 3,700 and 3,760? Short-term traders, you can grab something in here looking for support. I would be very surprised if you don't see a bid north of 37.64. The low may have been 37.95. If it is wave 4, one more push down, then you get the bounce. Okay, no guarantees. That's my game plan. I've been wrong before. And then you get the push down. Alex came up with another interpretation that I'm going to flip this over. That wave 5 didn't end here on December 13th, but in fact ended here on December 1st. and that is this guy right here. This, for those who are schooled and studied in Elliott and are twisted enough like us, this solves a few problems that I brought up, which is, again, it's going to be difficult to squeeze a 5-wave move in here to do C of a zigzag. Alex brought up the point that, well, C waves are often a fraction or a fib multiple of distance traveled in A. So it's fine. It's possible that we'll get a little C wave down that could be 0.618 of A. Or what happens if the wave 5 move ended on December 1, not December 13th, and it's 3, 3, 5 for the flat, and we just saw the lows. That's possible too. That's possible too. And I'll tell you, with everything that's going on in this market, with the Fed just trying to bash us over the head for 5.25 Fed funds for longer, and you look at anything longer than a 5-year duration in the Treasury market, 3.5, 3.6, 3.7 rates. I mean, they say they're going to drive the yield curve so inverted for so long that they're just going to squash us and compress us and force us down, to 3,100, 3,200 in the S&P to get, 15, 16 times forward earnings, and that's where our alternate B wave would come into effect. If the Fed is telling us what they're going to do and forecasting it, I guess we have to listen to them. And I have all sorts of plans laid out for our trading business, for the wealth management business, to interact, take some shots down based on this, I think, highly unexpected move into support, moving higher as we start to move into the new year and get 4Q earnings, and we'll see what kind of earnings revisions we get. But if the Fed is really telling us what they're going to do and they're inflexible on it and they're willing to push us into sustained recession, then we're going to have to entertain the blue count. So that's the S&P up top, nowhere near as long as that. Here's the equivalent NASDAQ. NASDAQ has a sloppier look in terms of overlap off of the proposed wave 5 low. It's a diagonal. But what's interesting is actually the percent rally from October 13th to December 13th is the same. I was doing some research last night. I assume by the very sloppy overlapping nature of this in the NASDAQ, it was a shorter percent change. It's about the same. We dropped down hard. Here's the other issue with the NASDAQ. And I'm going fast here. I'm really not trying to sugarcoat this or make this easy. The NASDAQ dropped sharply. And what you'll notice is the equivalent should hold, must hold zone. We got through the 618 retracement of the proposed 5-wave. Oh my God, I'm not showing my screen. Why don't you guys yell at me? You guys should have yelled at me.
Yeah, I just wanted to start yelling.
Oh man. So here is the NASDAQ, the equivalent 5-wave move into 618 retracement at 11,068, and we're through sort of the should hold zone. So what's even harder is if we're going to get B wave up and then a 5-wave move down in C, can we hold the 786? That's going to be a tall order in my opinion. So Alex, it just goes to your point. Here's the equivalent in the NASDAQ. Did the 5-wave move, which is a diagonal, end December 1, and it's a flat ABC, 5-wave move down, and we've got everywhere above 10.8 is solid, and then we can get the move higher. Again, the possibility that we are going significantly lower, we're going to get all kinds of earnings revisions. I'm waiting for that to come out. We need more clarity from the Fed. There's a clear discrepancy here as your long rates, your 30 years at 3.69. It's come up off the lows a little bit. Your 10 years at 3.629 come off the lows. It's come off the lows as well. In terms of the 10-year, I have been looking for on this hourly A, triangle B up in C, a little clustering of 4v3, 4v2, typical wave 4 resistance. It's held. So if this is going to play out, we still think, I think Alex is on the macro side looking for 3.4, 3.3, maybe even 3.2 on the 10-year. Is a higher 10-year treasury a result of risk aversion, safety buying, or is it reduced long-term inflation expectations? That's that macro flow we have to watch. The other thing I'll put in front of you, I'll just tease this up. I think Terry, you going to hit semis, or what do you in your section?
Yeah, we can talk about semis.
Okay.
I'll do my normal stuff, and then we'll cover that at the end.
Okay, got it. Semis, again, off the low, October 13th up to December 13th. I mean, what a nice 5-wave move. There's nothing 3-ish about this, in my opinion. Question is, again, you need something that resembles a good wave 2 pullback. Is it A? Is it B? And C down. Semis so far off the low, obviously no problem with the should hold, must hold zone, because that would be a very typical comfortable wave 2 pullback zone. We have some long semis on. We have a bid, an AMD for our portfolio. All that said, you know, I do have some hedges on. I'm hedged in the wealth management side. I have inverse ETFs in wealth management with TA clients, trade analysis. I have a little QQQ on here for fun at 13 Gen, 277 half, 270 put spread. I took half off. We're short target. We have some long holdings here that are obviously not working right now, but we have some hedges on. So we're playing both sides of it and trying to stay open-minded heading into new year. So I just want to hit that at the top. There's some interesting commodity plays that we're looking at here. Silver, gold. Alex was going to talk about it. Silver is making a pretty good move up. And Alex, I know, wanted to jump in. This is a long-standing macro relationship. When I used to trade for an FX fund, I learned about this in my 20s. And if I had quotes that went pre-91, you'd see a better relationship. But gold-silver ratio has a nice inverse relationship with the stock market. Silver is an industrial, but also precious, but also an industrial metal correlated with growth, where gold, mostly a risk-off inflation hedge, doesn't usually correlate in the same direction the stock market. So silver's outperforming gold. You'd expect to see a stock market bid. Well, that correlation fell apart through 2011 on up to 20. But all of a sudden, we're starting to get a little bit of a return to the traditional gold-silver relationship. And if you go over here, squish up an hourly, you'll see that this white line means silver is outperforming gold. This is gold-silver. Gold underperforming silver. So as that's happening, the S&P put in this sort of double bottom, starting to come up off the lows as silver is outperforming. And if we continue to break through the 75 gold-silver ratio, that would suggest to equities that silver is more in demand than gold. And if you just look at the wave count in silver, it's pretty simple and pretty interesting. Just a nice little 5-wave move with a downtrend, little trigger point there into about 25. And this move in material stocks that we're seeing very much could continue, and there's some opportunities in there. So sorry for the fire hose. Alex, Terry, follow-ups, you guys want to jump in? Or who wants the screen?
Alex, you can go ahead and talk about silver if you want. I'm not covering anything with gold or silver.
Yeah, okay, so let me just take the screen and continue. Just a sec.
Yep. Grab it in Zoom.
Sure. Okay, so yeah, we have been talking about this gold-silver ratio a couple of times. So this is just kind of a simple ABC.
Hey, Alex, share the other screen, bud.
Oh, sorry. Just a sec. Sorry, guys.
There you go.
Yeah, so just we have been looking through this chart a couple of times in this Wednesday streams. So I'm looking silver to outperform gold in the next move on the upside. So this might be the end of the gold.
Wow, that's a big move. And, big move in gold silver. Yeah. Wow.
Which is I mean, 5 waves down, some type of a flat up, and then this is looks like a leading diagonal, which means that we might be seeing something like this to this equality levels, because silver gold ratio goes in the ABCs. If you look the whole chart, it doesn't have a whole of the five like impulsive waves on the weekly and monthly. So this will be a simple 5 waves down with a flat on the upside, 0.618 retracement levels, and from there we have a nice forming leading diagonal to the downside. And after a pullback, if we continue to move lower in this in this favor for silver, that will definitely start silver bull run on the upside in 2023, even 24. So if we look gold silver on the charts, we dived into that a couple of times. Obviously, for me, dollar is a more of a gold correlation. Of course, the macro flows, but in gold, I think that we agree that dollar is something which is more significant as a correlated asset than any other thing for now in gold. So it's a really simple 5-way move calculation. We looked and we followed through this with our clients. This has been a treacherous correction for a long time. So January, February 2020, and we are 2022. So this was a 2-year consolidation, which is basically relying on this time elapsed in this wave 2, and we came to equality. This is also a symmetry that we usually look. We came to equality into the time ratio of time elapsed in a wave 2 and wave 4. And we have a kind of a nice 5-wave move on the upside. So in that respect, after a pullback and 200 on weekly, which is a reliable thing for me in the respect of all other things that we use, kind of a pullback down back to it might show that we are going to be ready to go on the upside in gold. And silver also look bullish from that perspective. We follow that many times here on the weekly, on the Wednesday's webinar, which we have on a weekly levels. So ABC pullback. This is just a simple leading diagonal in A, down in B, and up in B, down in C. So if we are done, we should see some type of a 5 waves up. And usually when the first impulsive sequence go above the channel on the upside, there is a higher chance that the pullback will be played again down to this channel line and then reversal on the upside. So it's forming a kind of a nice breaking pattern. Usually we look for a channel break technically, because it portrays definitely a strength over these resistance zones. And then we're going to look for a small pullback, much smaller in silver than in gold, looking at that ratio. And then potentially somewhere around February, March, silver can start third over third on the upside. So really interesting setup, which is forming here. Okay, so what I'm looking, we talked about the dollar yen. So actually the yield curve control on the side of the Bank of Japan, what they did a couple of days ago was actually they increased, in my opinion, just interest rate. So when we look actually dollar yen, so 5 waves up, post triangle trust. And we talked about this. Central Bank of Japan has been intervening a couple of times here, and also I think it was there some around kind of a warning that this carry trade and new entries might unwind, since we had a big interest rate differential, because you have Japan at 0.25 yield curve control, and you have actually Fed around 325, 375, 425, and that's actually kind of a spurs carry trade where you lend relatively cheaply yen, and then you buy dollar, and then you actually put it on deposit or buy treasuries shorter term, and actually you have a nice nice payback. So that's a kind of a usual interest rate carry trade thing, which has been happening in the last 20 years a couple of times. But actually what they did, they actually expand the band, which means first level, they were buying everything at 0.25, they expanded to 0.50, which means that it's basically 0.25 rate increase actually. So I do think we are in a five-way move down in the dollar yen. I look this as an ending diagonal forming, and we will see a pullback, and then I will probably see a continuation as the Fed plateaus with rates. This carry trade, I think, will fade a little bit because it is not going to be forward looking, so we must actually go further lower to find a medium price, how the market will actually then price the potential this interest rate differential between them. So basically, Bank of Japan hiked 25 basis points, in my opinion.
Alex, let's bring
Yes,
it back to
yeah.
a lot of echo. Let's bring it back to did you change something on your end? Let me just mute you
No.
here. Todd, did you get that echo from him?
No.
Oh, okay. Oh, interesting. So if you just look at the 10-year yield over dollar yen, just to kind of pull that into what Alex is saying.
Yeah.
I know. Here we go. I know what's going on. Sorry. The correlation here between 10-year yield is pretty significant over dollar yen. And Alex, it's interesting that 10-year yield took a big drop there December 7th and has come back, and then dollar yen kind of did the catch up with the Bank of Japan move 2 weeks later.
It was exactly here.
Yeah.
So actually, the correlation works pretty well because of what we have just been talking. And then when the 10-year yields moved a little bit higher, we still look for lower yields because we label this as a wave 4. But this change of the 0.25 to 0.50 band actually caused dollar yen to break a little bit this correlation. Otherwise, the dollar yen will correct with the 10-year yields on the upside. So for now, we will see how the market will react, but I see this completing soon, a small pullback and then a continuation to the downside. So we might play something on this on the ETFs on a dollar yen. So I think it's setting up a nice shorts and buying yen at some point.
Got it. Good stuff. Good stuff.
Yeah.
Anything else you want to hit?
Yeah, let me just go over dollar index. So also our case with dollar index was that the 5 waves up most likely is done. We have a pretty nice 5-wave forming to the downside. So this is also very significant for the future. So I'm going to show you 4 hour. We are looking for a 5-wave move to complete very soon. So dollar will make some type of a pullback from January 2023 or beginning of February for some time, but this definitely starts to look as a 5-wave move, which means at least we're going to have one more move down, which kind of agrees with us, without our outlook for emerging markets, relief, and also stocks going higher in 2023. So this macro flows kind of showing potentially after a pullback, we might see dollar moving lower, supporting less pressure, less in the emerging market economies, a kind of a better situation in their future earnings because of the interest rates and price of a dollar, and then also spilling back to the US economy and moving up with the rates plateau with the Fed. So it kind of all fits together. I will just hit shortly Thomson Reuters index. So I still look this while the dollar corrects to move down in commodities. So oil still kind of a floating here, not doing much. This is Brent crude, 81.65. Not something in particular what is going on here. And I do expect commodities to go in the first couple of months lower, and then when the dollar starts to tank heavily, I expect commodities to continue to go higher. I will just hit Bitcoin shortly.
Alex, but wait.
Look,
If you're bullish on silver and gold on the breakout, how does the commodity index go lower?
Yeah, this is 37 commodities.
Right. So it's softs, it's meats, it's not precious.
Almost all. Yeah. So this is very low weightings from gold and silver in that respect, that they will actually drive this.
Okay, got it.
And from the perspective of Bitcoin, we have kind of a resemblance. We have been kind of beating our drum for descending diagonal. We finally had the confirmation with our members. We were waiting this. It is interesting, that this is the overlap, which is the only allowed overlap we have in the Elliott wave theory. And actually, we just overlapped it and flashed down in 5 waves. So this kind of agrees also with a couple of scenarios we have with the S&P. And the ending diagonals are telling patterns. They are actually telling you about the reversal. Bitcoin has been moving down, as you can see, from November 2021, and we are potentially coming to a significant midterm or a longer-term low, in my opinion, between 14 and 15K. Why I'm looking 14 and 50K? Because there is a particular a relation between each wave in the ending diagonal, and that is very specified. So if you have a wave 1 longer than wave 3, then wave 5 will be shorter than wave 3, and then you can size up some of the levels where this my low might be. So we are structuring something with our members. I already announced that. So it's going to be interesting times in beginning of 2023.
Nice. Terry, you want to take it?
Sure. Let me figure out how to grab the screen here.
Okay.
Lost that link again. Got buried behind something. There we go.
Okay.
All right, you got it now?
Yep, ready to go.
All right, hello traders and investors. I'm Terry Long at TradingAnalysis.com here with your weekly sector focus. So Christmas is almost upon us, only a few more days. Get that last minute shopping done. All right, let's take a look here. Last week, markets initially ran up Monday and Tuesday ahead of that Fed rate decision, but then reversed lower after that announcement of that 50 basis point hike. For the week, last week, the S&P was down 2.08%. Index declined 2.76%. Now, both of these indexes had penetrated up, well, I will say the S&P had penetrated up to its 200-day moving average, and then has made a pullback back down to the 50 and a little bit below right there. The index never really made it to its 200-day moving average before also pushing lower back down to the 50, and then now it's tracing a few steps below the 50-day moving average. Now, last week, the energy sector remained the only sector in positive territory, up about 2%, and the week's worst performer was the consumer discretionary sector. Technology and communications also underperformed last week. Let's fast forward to this morning. This morning we have 2 days worth of price action in ahead of the bell. It's going to ring here in about 5 minutes. S&P is down about 0.8% on those 2 days. I think futures were up the last time I looked at it. Index down 1.52% in those 2 days. And once again, we're seeing the energy sector being up about another 2%. Not really aggressive. All the other sectors lower. Pull this little table over. I get a little bit of pre-market action there when this chart was formed yesterday, the energy sector was the only one in positive territory. Now we're seeing a little bit of pre-market action, maybe pushed up the financials and the industrial sectors just to slightly positive. On the downside, communications, real estate, and consumer discretionary are still pushing lower. All right, moving over to our relative strength sector leader scoreboard. And despite the 2% gain in outperformance in energy, it's still showing a momentum drifting lower. Now, the relative strength remains high in the energy sector. So I don't doubt the fact that we can continue to see outperformance here in the energy sector. Just note that that upside momentum push is kind of stalled out. Also, both industrials and materials sectors continue to gain relative strength and momentum as their vectors push further here into the leading quadrant. It also looks like a little bit of neutrality here. The momentum is to the upside, looks to be leveling off in this last leg here. In the financials and the healthcare sectors, they remain with strong relative strength, but they are also showing a bit of declining or a bit of momentum decay. And staple sector also, again, it's the weakest of the leading sectors, I'll say, because of its lower relative strength position. But it has been making some slight steady gains. Now, over here on the left side of the chart, was down here in the lagging quadrant, but this week, look what's happened. Technology and real estate sectors have actually pushed higher up here into the improving quadrants. We've also seen a hook form back here in the utility sector. Utilities have been fairly calm and stable during the broader market decline, and I think that's being shown here as a rise and a rally in momentum back to neutrality. Again, anything right here at this 100 line is essentially neutral, but we have the advantage of the time factor to see that week over week over week we've been gaining momentum back up in these sectors here. Now, I do want to say something here about the communication sector. It shed 2.8% last week, and communications is down another 1.25%. It really, communications sector is now the worst performing sector. I think last week I told you that I would say that real estate was ready to overtake the communication sector. So real estate's gaining ground and pushing back up here into the improving quadrant, while the communication sector continues to lag. All right, so let's take a closer look at the semiconductor group here. I'm going to flip this over. We're going to look inside semis. This is one of the subgroups that I've been seeing a lot of activity. This is the stocks that make up the SMH, and week over week over week, starting back here in early November is when we actually started to see hooks form in many of the semiconductor stocks. Also, their vectors turned blue, which meant price action was back on the rise. Semiconductors have been out of favor for quite a long time, but now it looks like they are making another return and want to return back into leadership. Indeed, one of the positions, Todd, that we have in the swing desk portfolio, one of the first ones, is ASML. ASML is making a good push here right now. Back up into the leading quadrant. Now we have another pending order sitting out here for AMD, Todd.
Yeah. Do you want to jump in AMD? You want me to take that one?
Yeah, let's take a little look at this. So our pending order was set up based on this.
Yeah.
This is a 195 chart. This is a simple fib retracement here, where we're sitting here at the 61.8% retracement. Our buy order came in here, or we've got it set at about 63. Did we miss it yesterday when AMD's low dipped to 63.52? Or do we have a little bit more downside to go? So I'll ask you here if you want to take the screen away from me and show me your wave count if you've got that setup available, or we can just
Yep.
talk about it. I
I
think
gotcha.
we put our stop here just below the 786. So if we have a bull formation here, we really think that we're going to have a big run up, and actually our upside target's about $50 higher than in this move. So we're looking, play this out a couple of months to the upside in a stock position, and we're willing to take a small amount of risk right here, right? So if we're wrong and we break below that, and then it just goes, then the larger turn corrective move still is in play. But you kind of have to, if you're going to win the lottery, you got to buy a lottery ticket. So you have to be willing to risk a small amount of money, I think, in order to make a move. This is an early entry, right? This is not a conservative entry, because we're still seeing it coming down as we're trying to catch it coming back up, right? So I'll give it to you there, Todd, and take it away. Let's see what your wave counts look like.
Yeah, good call there. I'm just going to pop this out, just getting a little feedback here.
I will say that one thing I notice while you're doing that.
Yep.
And you don't have to give me this.
Go, yeah.
You can just keep going. The one thing I noticed is I'm not seeing divergence yet in the indicators on that time frame. So we're still making a lower low in price, and I'm making a lower low in the RSI, for example. So that's kind of making me think: do we want to have fear of missing out and just jump in and buy it now at 64 or 65, right, wherever it's trading, or can we give ourselves a little more time to the downside?
Right. Yeah, that's the big question. And let me just pop this out here. Let me just see here, Terry. Mute. Test. Okay. Terry, give me a 1-2 in the air, please.
Mic check.
Yeah, there we go. It's just repeating on Zoom. Got it. Okay. All right. So yeah, that's the big question on the table, as Terry was pointing out. It's I talked about in the beginning. This is an important thing to think about. Like, if you're not trading well, maybe you're missing entries. Or you're chasing entries only to have them come back in your face. That's something that, like, I always struggled when I was trading for a hedge fund. I was on Wall Street trading, during the global financial crisis. There was times where I'd be chasing, and I would be chasing incorrectly. And there's other times where I'm like, okay, let's step back and let's be more of a levels-based trader. And this kind of trade that we're talking about is just sticking your entry right at the support and right into resistance. You don't have to go the full amount, but you can stick a bit in, and there's going to be times where you hit it when you're using good quality analysis that allows you to think ahead and not react like indicators. You want to use leading indicators that allow you to identify potential zones of support resistance. So we stuck the 63 bit in there, and this is one of those times. Alice and I were trading during the GFC on FX, and you had to trade that way. Like, okay, we just missed the entry by 44 cents. The upside is massive, so then the question on the table is, okay, do you chase or do you wait for the pullback? And that's something that it all comes down to: position sizing, how long you want to be in the position, what your stop is. That all comes down to your trading plan. For me, for us, for what we're here to do, based on that conversation we had, is do we have one little wave 4 up in the NASDAQ and then a push down to get that 63 entry, or do you chase? And then you have to maybe adjust your size and jump your stop loss. It's all got to be part of the plan. I don't know, Terry. I would say AMD, being it's one of the weaker semis, because if you look at ASML is one that we have. Yeah. This is a much stronger semi. Oh, Alex, did you change the colors on there for me?
Wait a minute.
Yeah, you did. That's all right. We can use white. ASML is already, into support here.
Sunglasses out.
I know, right? Yeah, seriously. So ASML is stronger than AMD. It's also NVIDIA is stronger than ASML. So I'd be more willing to chase a stronger stock than something that is lagging a little bit.
Yeah.
So yeah, let me just we'll wrap. Do you want to add something to that, Terry, or keep going?
Yeah, I'm agreeing with you 100%. Relative strength, AMD, if you saw them on my rotation, relative AMD's pushed up into the improving quadrant, but its relative strength is way lower than NVIDIA or ASML, and it has it does have an opportunity to still underperform the S&P or the Nasdaq. So if we think we still got another push coming lower, I'd say fear of missing out. Don't let that pull you into buying. And this wouldn't even be the only trade that you can make, right? There's lots of other trade setups out there.
Yeah, absolutely. All right, let's rapid fire it here. I'm still holding Tesla as a decent size allocation in my growth portfolio. I did reduce it. It's kind of a fire sale right now in Tesla. The long-term wave count the support was broken, just about the 182. So best interpretation we're looking at, it is a triple ABC connected by X, another A, small B, and then we just peered off the cliff there at about 182.
You're not
so
showing your screen, Todd.
Oh, thank you very much. I need a shocker when that happens. No, we need a producer is what we need. Joel and Nick.
We're still bearish on Tesla.
Huh?
We're still bearish on Tesla for now.
Well,
in the short term. Well,
okay. So we got through the 182 level. Again, what I was showing you is ABC, and then here's your W. Then we go complex for another ABC down. As you get off the daily, down into, let's go half day. The first 100% projection of 3v1 was met at 139. Usually a third wave will go beyond the 100% price distance traveled of 3v1. So I hate to say it, we might be looking into this cluster here, 111 to 115 in Tesla, which then gives you the wave 4 bounce. It's a fire sale. I looked through, and actually I was posting some stuff this morning looking at the fundamentals of Tesla beyond the scope of what we're trying to do here in the small little Wednesday webinar. But they're just taking it out back and shooting it. Obviously, Elon's antics and Twitter back and forth are a huge distraction. But fact remains, we have earnings coming up. Margins continue to increase. They're growing revenues. They're growing their efficiency. I think this is getting to be overdone. I'm still bullish on the company. And then Scott on one of the YouTube channels is asking, he was saying at the beginning of the show that it looks like they're just gonna crack the Nasdaq, and possibly, but I would submit to you that, look, if you just take the Elliott wave off, if you just do this and just get simple, is this something that is end of the world? I mean, yes, we're up against trendline resistance. I mean, that's kind of haphazardly drawn. Why are you, I after 20 years in this business, I don't know how to properly draw trend lines and channels. If anybody wants to, I don't know, is that accurate? I don't know how to do it. If someone knows, let me know. But, is this going to be the top in Apple? As we get back into the wave counts, we're going to break some pretty key uptrend support here at about the 137. If we get down to the daily, the way it sort of plays out here is that break looks scary on the surface, but if we put a decent wave count on it, that move up off that long-term trend line that I was just having fun with, for me, guys, it looks like ABC, big old connector X, and then another A, B, and C. Alex notices this. I've known this for a long time. He has seen the same thing. Oftentimes, post-triangle thrust in a C wave will be shorter than net percent distance traveled in A. 61% of A is at 126.86 in Apple, and then you get the 100% W and Y at 123 Apple. I would be very surprised if it doesn't give this support zone some love. Now, you shorter term guys, I am watching this as a little wave forward. This is a 60-minute little wave forward. You've got that broken daily trendline support now offering resistance. Maybe that gives you a shot down to the 123, and then that would have the NASDAQ doing the C wave of what I talked about at the opening of the show, the C wave of the zigzag that should stay above the must-hold zone. That's Apple. And then you look at Microsoft. You know, for me, Microsoft is just, that doesn't say end of the world for me. That is a solid little 5-wave move with an expanded flat off the low. You're talking 236, 228 fib zone support and Microsoft. And even Google. Alex was talking about and doing some good work on Google longer term. There is support coming here in Google. Alex, is it off the blue? Yeah. This is a little deeper. Communications have been slapped around, but you have Google into some pretty key support here. I wouldn't bet the farm on it, but it is a good 5-3 down into some deep support. We're going to be watching that one as well. So I'm not giving up all hope yet. All hope yet. Mike, I have Tesla long in our wealth management growth portfolio. I was pretty significantly overweight, but I reduced in the last rebalance in September. So still hold it, but I've cut the holdings down. So yeah, end of year, as I said, it's end of year flows, tax loss selling is real this year. So I can't help but think Tesla might be caught up in that. There's some names out there that are significantly beaten down. So we have cash. We're ready to be building out our swing trading portfolio on the trade analysis side. We've got cash in the managed accounts and looking to deploy. But again, the possibility that the Fed's going to drive us down with their sharp rhetoric, fighting inflation, is not lost on us. So I'm going in mind wide open. Guys, I'll leave the closing comments to you.
Yeah, I agree with that, Todd. So, cautiously optimistic. I think we're at the end of the Fed has seen the light at the end of the tunnel, but they're going to continue their planned attack. I think the market was happy to price in, or knowing that it priced in most of what the Fed thinks they're going to do, right? I mean, it's all about the market's uncertainty as to what's going to happen, as to where the volatility is. And I think volatility will continue to decline the more the market is happy with the fact that it thinks it knows where things are headed in the future. So
I mean, it's volatility. It's crazy. I mean, vol is, what was it, yesterday or 2 days ago? The market was down 1.5%. The VIX was down 1.25%. It's like everybody who's wanted to buy put protection has done so, and that's one of the most known stats out there. Everyone who wants to be hedged is hedged. I mean, look at the VIX. The VIX is getting smoked. At the money puts and calls have no premium in them right now. It's a very interesting. I'm watching vol skew, which is not VIX. You're looking at out of the money puts and calls, the difference between the vol skew, looking at multiple standard deviations out, looking at the difference between puts and calls, and I mean that's at some pretty interesting levels too. So people have hedged, have already done so. We haven't seen in the AAII, the investor sentiment, we haven't seen people give up their equity positions yet. There hasn't been a puking of the equity positions because, again, I think anybody who wants to sell has probably already done so, and people are getting hip to options and they're hedging. So it's like, all right, we know what the Fed's doing. The Fed's trying to talk tough. Can they really keep the yield curve inverted for the next 6 to 9 months, like they're trying to say they're going to do, and squash the economy? I guess it's just one of the most forecasted recessions of all time. And just when somebody and everyone's convinced something's going to happen in the market, I've only been doing this professionally for 2 decades. More times than not, in this kind of situation, that which they expect to be certain does not occur. And I'm trying to figure out how and what the Fed's game plan is once they realize they do have to cut rates, even though they bang the drum saying we're going to 5.25 for a long time. They're trying to save credibility. I don't know what they're doing. Thoughts are welcome. George, that is going to be the comment that we wrap it on. Jerome Powell is the Grinch. That's it. Again, I'll leave last word to you guys. Anything else, or put a bow on it?
Yeah, in my opinion, I think that Fed is actually very happy to see inflation moving lower. I think this narrative is just a kind of a narrative warning. I mean, I don't believe that they're not going to plateau soon, stop raising rates, and so I think it was a little bit overreaction. In my opinion, I think 2023, uh, back and forth with some geopolitics, maybe falling a line around March. Uh, we might see we might see them actually plateauing for a longer time.
Yeah.
So
Yeah.
that's my opinion.
Let's just take a look. I haven't looked at
Yeah.
I haven't looked at the Fed funds rate in 24 hours, which is a record for me in this market. So February, we're still at 74% chance of 20. We're at 74% chance of 25 bips.
Yeah.
4.5, 4.75, and then we're only at a 14% chance of Fed funds getting a 5 handle. What the hell is the Fed? What are they talking about? Markets are calling their bluff. There's a huge disconnect going on.
Yeah.
In May, there's 21.6 plus 2.7. Call it 24% chance that the lower end of Fed funds gets a 5 handle. Something is not adding up here.
Yeah, exactly, and that is what actually is my closing thoughts. I think that is just a narrative. They're happy to see inflation lower and stop raising rates or plateauing somewhere around between 2 years is around 4.19. So I think between 4 and 4.5. I mean, that's the end for this cycle. Maybe we go a little bit more higher, but not much than that. So
I mean, look at the
I think
look at the 5-year the tips break even. We just made almost a new low for the year, 2.19 on the 5-year. So I mean, and look at the correlation between the Qs and tips. Maybe we want long-term inflation expectations to go back up and realize we don't have central banks going wild and they're going to push us into prolonged recession. Maybe we want long-term inflation to come back and realize they have sense, and this correlation that's been in place since COVID low would return. Maybe we need to get off the lows there. It's wild. It's wild. Anyway, let's go hang out with our members, boys. What do you think?
Yep.
Yeah, so that was the inflation chart I was just showing. You just want to show it. Like, look at this off of the 20 lows. Unbelievable. Unbelievable. So, fun times.
Maybe it's the kickoff of the Santa rally. It's time. That'll travel into the first 2 weeks of the year. We'll see. At least we'll see how that works out.
Yeah, we'll see if the Santa Rally is going to happen. So, all right, well, good show, guys. Thanks a lot of fun. Thanks for everyone from joining us from our 3 channels. I did it.
Yeah.
Thank you.
Give us
Appreciate
a thumbs up
it. Yeah, thumbs up. Come check us out. Trade Analysis. We're going to head into the members webinar. Lots to talk about. Guys, have a great rest of the year. Thanks for hanging with us. This has been a very transitional year. Our 10th year. Me coming back into the business after a 2-year sabbatical to focus on wealth management, which I've launched and we're up. Now the 2 companies are coming back together. So all good. It's going to be a very fun next 10 years. Hope you're with us. See you guys. Catch you.
Right.
Oh, wait, no stream next week. If you guys want to run when you can, I'm actually on CNBC next week on the 28th. We'll game time decision it. If you guys want to take the time off, you can have it. Whatever you want. Your call, boys.
All right. Happy holidays.
All right. Thanks, guys. See you, Alex.
see you guys. Bye.